On 19 July, the Indian Rupee hit an all-time low exchange rate of 80 against the US dollar in early trade. The government said that its value had fallen by 25% since 2014. Let's understand what exchange rate is and how it works and the factors behind the rupee fall. Though international trade and movement of people is increasing rapidly, there is no currency that is acceptable across the globe. Whether you go for higher studies to New York University or fly to Los Angeles for a vacation, you have to pay for services and goods in the currency that is accepted in the country. The rupee exchange rate of a particular currency, say the US dollar, tells us how many rupees are required to buy a US dollar. If the rupee exchange rate falls, it implies that buying American goods would become costlier. At the same time, Indian exporters may benefit because their goods are now cheaper to the American customers. How is it determined? In a free market economy, the exchange rate is decided by the supply and demand for rupees and dollars. Imagine that in the beginning, 1 rupee was equal to $1. After a year, Indians demand more dollars in comparison to Americans demanding the rupee. In such a case, the exchange rate will fall or weaken for rupee and rise or strengthen for dollar. However, in India, the exchange rate is not entirely determined by the market. From time to time, the RBI intervenes in the forex market to ensure that rupee price does not fluctuate too much or that it doesn't rise or fall too much all at once. The rupee's fall has been mainly due to a rise in crude oil prices, a strong dollar overseas, and persistent foreign capital outflows. The backdrop of heated inflation prolonged by lockdowns in China, the monetary tightening campaign of the central banks, and supply chain disruptions caused by the Russia-Ukraine war have led to steep depreciation of the rupee against the dollar. For more news, views, and insights, visit business-standard.com.